Good afternoon and good morning to everyone. This is Gary Carpenter with the NCAG, and today we're going to have a presentation on student loans, sort of a current update for 2014-2015. Before I start that, just a couple quick items. This is going to qualify for continuing education for CPAs, CFPs, CEPs, CCPSs, and CCAs. During the presentation for CPAs and CCAs, I'm going to be giving the answer to 4 individual questions as I've done in the past. You'll then use these to go to the website to report your continuing education for CPAs, answer the 4 questions. You'll then be able to print out a certificate for your continuing education. I also sent instructions on reporting continuing education earlier this morning. I think everyone got one. If you didn't, please let me know. For CFPs, it's going to qualify for 1 hour continuing education. Email me your last 4 digits of your Social Security number or your license number, and we report that directly to the CFP board. We're also going to have continuing education for CEPs, forgive me. Just send me your certificate number. We'll then prepare a certificate for you for units of education and mail that directly to you with supporting documentation. For CCPSs, this is a self-reporting program where you go on to the NICCP website, select My Account, enter your password, then go to Reporting Continuing Education, enter the organization's name, which is the National College Advocacy Group, and the title of the presentation, and you'll have your CPE there also. Couple quick items before we get started. I've mentioned this in the past, but we do have a free conference with the U.S. Department of Education in Atlanta. It's going to start on December 2nd and go through December 5th. That's a Tuesday through a Friday, and that is the week after Thanksgiving. Again, emphasizing this is a free conference. You do have to pay for transportation there and for your housing. We've been there in the past. We're going to be going there again. If you cannot make it, all the sessions are recorded and are on the website for the U.S. Department of Education, and you can listen to them there. Finally, we have another webinar coming up here in December. It's going to be on December 17th. It's going to be the FAFSA 2015-2016, and this is going to be presented by Al Hoffman. Again, this is going to be an update of what's new in the FAFSA area and the reporting form. So again, you'll be getting an email on that shortly as far as linking up to register for that. Also, I sent slides out to everyone earlier today, and I sent it out with the notes. Why I did that is there's a lot of information here, and many of you may want to print these out and just keep it as a reference material for the future. I tried to update all the information to current interest rates, fees, terms and conditions, so hopefully it'll be helpful to you in that matter. This webinar is going to be recorded, or it's being recorded right now, and it'll be on our website within 24 hours. Finally, I'm going to try to get through the material. We've got a bit of material here, and I'll answer questions at the end if that's okay, simply to be more efficient here. But if you have a question as we go on, type it in, send it to me, and we'll get at it towards the end of the webinar. So let's start right off. You can see my first slide there, Student Loans 2014-2015. You know, when I first got involved in college financial planning 15 years ago, and I was sort of gravitating towards student loans, it was a pretty simple arena. There were federal loans, Stafford, Plus Loan, maybe a Perkins. There were private education loans, but it was pretty straightforward, pretty simple. Today, it's very complicated. You're looking at federal loans, Stafford, subsidized, unsubsidized, Perkins loans, grad plus loans for parents. Then you're looking at the consolidation of these loans. Then you're looking at repayment options afterwards, and that's just on the federal side. You look at the private side with private education loans. There still are lenders out there that are actively marketing their products, and they also are now coming out with programs as far as consolidating those private loans. So again, it's a different arena right now, and it is becoming very complicated. Okay, let me move on here. So what are we going to cover today? We're going to cover student undergraduate loans and student graduate loans. We're also going to take some time and talk about consolidation, and we're also going to do some case studies with income-based repayment, or IBR, and pay-as-you-earn, or payee programs. And these are programs that are new within the last 5 years as far as payment options for students. And finally, we're going to touch a little bit on the public service loan forgiveness program, which in some cases may be available to students that are working in public service. So let's go right on to this here. Loans for undergraduates. We've got them all listed down there. We'll go through them one at a time. So let's just start at the very top there with the federal unsubsidized Stafford loan. As everyone knows, if you file the FAFSA form, you're going to qualify for the federal Stafford loan unsubsidized. That's all that you need to do in order to obtain that loan. There's no credit or income check. It's not a need-based loan. It's offered to every student who completes the FAFSA form and is at school at least on a part-time basis. These loans have changed as far as interest rates and terms and conditions over the years, but let's just I'm going to talk about the immediate situation. Is the present loan has an interest rate of 4.6%. Interest accrues on this loan while the student's in school, and then when the student gets out of school, they can do what's called a interest capitalization, which is essentially taking all that interest that's accumulated over the 4 or 5 years of college, add them onto the principal, and then make that the total loan to be paid back. Also, there is a fee associated with this. Now, the fee used to be like 1%. With the new legislation that went into effect back in August of 2013, I believe it was, they did some modifications to the fees, and that they're slowly going up, it seems, each year. It used to be a 1% origination fee. Last year, I believe the fee was 1.072. This year, it's 1.073, and it's going to escalate next year also. And now it's based on an academic year, July 1st to June 30th. Let me correct that. It's based on a year of October 1st to September 30th for the fees and any increases in the future. You're going to be able to borrow up to $5,500 for your freshman year, $6,500 for your sophomore year, and $7,500 for each of your junior and senior year. And should you go a fifth year, you're going to have the ability to borrow an additional $4,000. Now, as I said, these loans are not going to be paid back until after the student gets out of school, but the interest is going to accrue on that. And one question I often get is, I have the option to pay the interest on this loan now while I'm in school. Should I go ahead and do that? I personally, from a finance tax position, suggest no, let's not pay this interest right away. If you're going to pay it, let's just hold on to that money until the last semester, which is usually the spring of the senior year in college. Before you graduate, pay the interest off then. Why we do that is because there's a deduction called the student interest loan deduction, which is what we call an above-line deduction, and the student can deduct up to $2,500 a year for student loan interest. If you pay that during the time you're in school, that student's probably not going to have any income and won't be able to take advantage of that deduction. But if you wait till like the last semester, graduating in the springtime, getting a job, working for 6 or 7 months, they're going to have income that's going to be taxable, that you can deduct from it the interest on this loan. So again, that's one of the reasons why I ask families to defer payment. If they're going to pay it, defer it to the last year. The other thing too, many families say, well, I'm going to help my child pay the loan, okay, and I'll just write a check and I'll make the payments. Well, that's good, but if the student is going to qualify for the student interest loan deduction, he's not going to get it because someone else has paid the debt. The only person that can take that deduction is the student in what he pays or she pays. So in those situations, I recommend to the family that they gift the money to the student when they start to make payments to repay back, and then the student make the payment directly to the lender or to the servicing company in order to get the deduction for the student interest loan deduction. So those are really the highlights there. I think one other thing I want to bring to the table also is the fact that if a parent student is turned down for a PLUS loan, and this is where both parents have to be turned down. If they're both turned down for a PLUS loan, then the student's going to automatically qualify for an additional unsubsidized Stafford loan. And that additional amount is $4,000 for the freshman year, $4,000 for the sophomore year, and then $5,000 for each of the junior, senior, and if there happens to be a 5th year involved. So again, it's how often do we see this? Well, not a lot, but it is there, and especially if there is some financial need and a poor credit situation, this could help the student. Also, there are maximum amounts that students can borrow under this federal Stafford loan program. Total Stafford loans, whether they're subsidized or unsubsidized, cannot exceed $31,000 as a dependent student, and if you're an independent student, that total amount cannot exceed $57,500. And they track this, believe me, quite closely. I have a client who is going to school part-time. He has 2 courses left. He's met the maximum limit of $57,500 as an independent student, and now he's got to look for other sources as far as funding those last couple of years of school. Okay, let's talk a little bit about subsidized Stafford loans, and this is going to be pretty easy. The main difference between subsidized and unsubsidized is that while that student's in school, the government's going to pay the interest on their subsidized loan. And once the student gets out of school, let's say they work for a year or 2, decide to go back to school again, then the government's going to pick up the interest on that subsidized Stafford loan while the student's going back to school. So that is a major advantage. Interest rate on this loan is also 4.66% for this year. And let me just talk about interest rates on subsidized and unsubsidized. Under the new program that Congress passed in August of 2013, they've gone and they've taken the interest rates and tied them to the 10-year Treasury note. And what they do is each May they look at the 10-year Treasury note, they find out what it is, and to that they add a percentage to determine what the interest rate is going to be for a Stafford loan for the upcoming academic year. So, for example, in 2013-2014, the rate for Stafford loans was 3.86%. This year, the Treasury bill rate went up, and therefore the Stafford loan rate went up to 4.66%. Now, it's gone up, but also it's fixed. And what I mean by that is once they determine what the interest rate is for an academic year and you borrow the money, that loan is fixed at that rate for the life of the loan. So if you had a Stafford loan in 2013-14, it's 3.86% interest rate. Take out a Stafford loan this year, it's 4.66%. This is also going to qualify for the student interest loan deduction, once the student gets out there, starts to make payments on it, and is assuming responsibility for it, they're going to be able to deduct that interest. And again, a side note on the student interest loan deduction, you don't have to itemize deductions in order to get this. It's what we call an above-the-line deduction. In other words, some of you are familiar, if you make a contribution to your traditional IRA, you get to subtract it from your income on the front of your 1040. Student interest loan deduction is the same thing. The interest you've paid, you get to deduct right on the front of your tax return, whether it be a 1040 or a 1040A. So again, it is a benefit to the students. Also, subsidized and unsubsidized Stafford loans are going to qualify for consolidation under the Federal Loan Consolidation Program. And we'll talk about that a little bit later. Fees, like the subsidized, there is a fee. I'll call it an insurance fee. This year it's 1.073%. Now, we talk about the amount of the Stafford loan. A student can have a total Stafford loan for, say, the freshman year of $5,500. Now, is all of that going to be subsidized, say, if they qualify for a subsidized loan? No. How they work it is $3,500 of the $5,500 is subsidized, and the remaining $2,000 is unsubsidized. And it works that way going forward for the future years. If you fully qualify for a subsidized Stafford loan, you're only going to have a $2,000 unsubsidized. The balance would be subsidized. So, for example, sophomore year total Stafford loans can be $6,500. $2,000 would be unsubsidized, and $4,500 would be subsidized. Okay, also in my notes I put in some more information about interest rates in prior years. And are you going to have immediate need for that? No. But if you ever run into a situation where you've got to consolidate some loans and they were dispersed during different years and you need to find out what the interest rates are, this might be a source you can come back to as a reference. Okay, let me give you the answer to the first question for CPAs and CCAs. The answer to question number 1 is Perkins loan. Again, answer to question number 1 is Perkins loans. Okay, here we are at Perkins loans. Another federal program, but they work this in conjunction with the colleges. The loans we've talked about as far as the Stafford loans are funded by the U.S. Department of Education. They are the sole source of money for these loans. The Perkins loans are funded in part by the Department of Education, but substantially funded by the universities and colleges themselves. And what they do is they enter into a program with the U.S. Department of Education in which they take a portion of money that they want to offer as Perkins loans, and they enter into the program with the U.S. Department of Education. Now, this is a need-based loan. Not everyone can get this. You have to have a very low expected family contribution. I think it needs to be below $5,500. And again, don't hold me to that number, but that's what sticks out of my mind from past months or so. This program has recently been updated. In 2009, they increased the dollar amounts that could be advanced. It used to be up to $4,000 for an undergraduate student. After June 30th of 2009, they increased it to $5,500 per year. And again, the college determines how much this loan is going to be for. So they'll look at the financial need of the student. They may come back and say, here, you've got a $2,000 Perkins loan based on the information we have and what we're going to advance out of the program. This loan is subsidized by the government, meaning that as long as the student's in school, the government is going to pay that 5% interest. Now, it's one thing when you have a Stafford loan who is being funded by the U.S. Department of Education. It's another thing when you have a Perkins loan that's being funded by somebody at the Department of Education, but most of it by the college themselves. And in those situations where the college has their money into it, they're receiving the 5% interest on that money. I have seen some situations where you may go back on an appeal, and one of the things you might target are Perkins loans, saying that you would like an additional increase in your Perkins loan as far as the appeal process. So just keep that in mind. These loans, the maximum you can borrow today is $27,500 for an undergraduate student. They are going to qualify for consolidation under the federal loan program. A couple minor differences between this and the Stafford. Stafford loans, you have up to 6 months before you have to start making payments on the loan once you leave school. The Perkins loan, they've extended it. You have up to 9 months before you have to make a payment on the loan after the student's left school. So it's a little difference there. It really comes into play when students have left school and you're looking as to, are you going to consolidate loans? What are you going to consolidate? Yes or no? You've got Stafford, you've got Perkins. You just want to be aware that once you do a consolidation, the old loan is no longer in existence, and therefore its terms and conditions have gone away. And I think where that's important with the Perkins loan, if the student has a Perkins loan and they meet certain qualifications, they may qualify for forgiveness of the loan depending on where they're working and the type of work they're doing. Example, if you had a teacher who had a Perkins loan, she's working in a very depressed area, or he's working in a very depressed area, there may be a portion of that Perkins loan that's forgiven each year that they work. Now, the best way to find out about this is to contact the Human Resource Department for the employer to see if their Perkins loan who qualify for forgiveness under this work program. Again, remember, when you do that, there is an advantage there, there's a benefit. When you do a consolidation, you put a Perkins loan in it, that forgiveness goes away under the Perkins program. So I know I'm harping on this, but it's important that you remember this little detail that you don't get caught up later on. Okay, Federal Plus loans. This is going to be in the name of one of the student's parents. Okay, I usually recommend if one of the parents is going to take the Plus loan, that same parent take the Plus loan throughout the life of the education of the student. In other words, each year for 4 or 5 years, that parent, the father, let's say, is going to take the Plus loan. You want to make sure he takes it each year going forward. This is not a need-based loan. It's not merit-based either. It's a credit-based loan. It's based on the information supplied when you make an application online. And by the way, the website for that is StudentLoans20142015 to apply for the Stafford loan and for a Federal Plus loan. You can borrow up to the total cost of college, less any other loans, financial aid, or educational tax benefits that you might have been able to take advantage of. This year, the fixed rate is 7.21%. It's inching up. Like the Stafford loan I talked about a little earlier, it's based on the 10-year Treasury note, and as that note goes up, so will the interest rate. So if a parent takes a loan out this year, the rate's going to be 7.21% for the life of the loan. If they take out a loan next year again, they're probably going to have a little higher interest rate. Now, there is a cap on this under the new program that was passed back in August of 2013. Interest rate cannot exceed 10.5% for a Federal Plus loan. So there is some protection there. There are fees associated with this loan. It used to be a 4% origination fee, which included the insurance fee also. With the new legislation back in 2013, they've increased that fee. This year it's going to be 4.29%. I'm sorry, 4.292%. And again, this fee is deducted from the proceeds of the loan at disbursement time. The loan's going to qualify for consolidation under the Federal Student Loan Program, And if the parent's income meets certain requirements, they're also going to be able to take the student interest loan deduction. As many of you know, PLUS loans have a death and disability benefit that are available to the borrower. If the borrower dies or becomes totally disabled, this loan is going to be forgiven. That being said, you must also remember from a tax standpoint that a forgiveness of debt like this is going to generate taxable income. One of the things that came up with legislation in May of 2008, it was under Ensuring Continuing Access to Student Loans. In that legislation, they made some changes as far as repayment. Before then, repayment started 60 days after the last disbursement of the loan. So if you took out a loan for $20,000, you got half of it in the fall, the other half in springtime. After you got that last disbursement, you would start to make payments within 60 days thereof. With the new legislation, they came back and they said, okay, you can do that, or you can make interest-only payments while the student is in school. Or a third option, you can defer all payments until 6 months after the student leaves school. Now, in this last option, any interest that accrue is going to be added onto the loan, and there'll be an interest capitalization, as we talked about in the unsubsidized Stafford loan. This was done in order to help some families that were struggling during the financial crisis there, and it is still available. As a side note, new legislation, well, not legislation, new information and requirements have been released, and the administration has said that parents who have applying for a PLUS loan used to go back and look for 5 years worth of credit history to apply for a PLUS loan. Applications after July 1st of 2015, you only have to go back 2 years and look for when doing a PLUS loan application. So they'll do a credit check going back 2 years. If you have a disputed debt of less than, I think it's $2,035, that's not even going to be taken into consideration. So with this new program, the Department of Education said about 370,000 families that wouldn't have qualified for a PLUS loan now will qualify for a PLUS loan. That's all good, but let's face it, if you have a problem applying for a PLUS loan, which is one of the easiest educational loans to get, and you can't get one, loosening up the credit requirements is just going to cause those families more and more problems. They're going to dig themselves into a hole financially that they're not going to be able to get out of. One quick note I'd also like to say about PLUS loans, we talked a little bit about income-based repayment, or IBR, and also pay as you earn. Those payment options or programs are not available to parents who have a PLUS loan. Those are only available to students. Okay, let's talk about private loans very quickly here. They're out there, they're available. In the past, these loans, they are credit based. There's no two ways about it. And they're going to ask for a co-signer because a student is not going to have the financial strength in order to carry one of these loans himself on their credit. So there's going to be a co-borrower that's going to be required. The loan's going to be in the student's name. There's going to be no cap on the interest rate. Interest rates have been variable in the past, and they've usually been tied to prime or LIBOR, and they are adjusted monthly as those rates go up or down. Some lenders today are offering fixed rate private loans. Now that sounds good, but you also have to remember, if they're offering a fixed rate loan like that, the interest rate is going to be substantially higher than what the variable rate would be. So again, it may be an avenue the student wants to go, but you have to look at all the terms and conditions on that. As I said, it's credit based. They're going to need a cosigner. Now, something new in this area is some of these lenders are offering the benefit that if the student comes out of school, makes so many timely payments, and it can be anywhere from 24 to 48 timely consecutive payments, the student can go back and request that the parent or the cosigner be removed from the loan. And if they are, then the cosigner is off. Now, one of the things you have to be careful are some lenders are offering this as a one-time offer, okay? Other lenders are saying, okay, if you don't meet the criteria where your credit is strong enough for the loan after the first application, you can come back after a certain period of time and apply again. So again, if you're going to go into a private student loan, look at the terms and conditions, look at the interest rates that's going to be available, look at the benefits that are out there, look into this release of the cosigner, because that could be important going forward. Some of the lenders do have limits on how much they will allow to be borrowed. It's either an annual dollar amount, say like $25,000 or $30,000, or they'll go back to the situation, the cost of college less aid and other loans, federal or private loans that may be available, would have to be deducted from the total cost before they determine how much they were going to lend the student. The other thing I'm going to mention is private student loans are becoming, well, they have been very hard to consolidate in the past. They're getting a little bit better, and we'll talk about this later, but it's something you want to take into consideration when you're thinking about how you're going to repay these loans when the student gets out of school. Consolidation can be very tough under private loan programs. Federal student loans, it's extremely easy to do the consolidation, and we'll talk about that in a few minutes. Okay, I'd like to give the answer to question number 2 for CPAs and CCAs. The answer to question number 2 is fees. Again, the answer to question number 2 is fees. Okay, let's go on to college loans. Now, these are either loans that are administered by the college themselves, and they use their endowment funds in order to do these loans, or they could be a program in which they're working with a lending institution in order to do college loans. And that's important. I mean, if you're looking for, if you're offered a college loan, you want to see how independent the loan is. I'm sorry, how independent the college is in the situation. If the college just has an agreement where they send you to a commercial lender, you can do that yourself. You can go to a private lender, you can make the application. If the college is offering a loan program in which they are the lender and it's coming out of their own funds and they're setting up the terms and conditions, then this is probably something the student wants to look at. It's going to be in the student's name. There's a good possibility it's going to have a fixed rate, and no payments are going to be made until after the student gets out of school. Now that's if the college loan is, the college is the lender coming out of their funds themselves. If the college just has a program with financial institutions, yeah, it's going to be in the student's name, but it could be like any private loan, variable fixed rate, hard to consolidate, limited repayment terms. So again, you just need to be cautious when you go in that. It will qualify for the student interest loan deduction. It's not going to qualify for the federal student loan consolidation program. Real quickly, some states offer loans to residents who are going to school within the state. I believe New Jersey does, and I believe South Carolina does. These are usually pretty good programs. They'll have a fixed rate, no payment required while in school. The dollar amount's probably going to be limited, but again, it could be one of the better ones to look at before you have to go to a private lender. Okay, so we've gone through that. And I have a lot of blank pages here because that's where my notes were, so I'm just going down to the next slide. We're going to go through loans for graduates now. A lot of the stuff we're going to talk about here, we've already talked about for undergraduates, but there's some important things I want to pull out here for you. graduate students can apply for a unsubsidized Stafford loan. And again, by filing the FAFSA form for graduate school, you automatically are accepted for an unsubsidized Stafford loan. Now, this year's rate is 5.41%. So you can see where it's higher than what an undergraduate Stafford loan is. Undergraduate is 4.66%. Okay? It has the same fee as an undergraduate Stafford loan. Payments don't have to be made until after they get out of school. That interest rate that is determined is fixed for the life of the loan. One of the important things is that the dollar amount that can be borrowed now is $20,500. Okay? If it's a medical student, it's $40,500. So loans dispersed, I believe, after June 30th of 2012, the total amount you can borrow is $20,500. Now, the maximum that you can borrow for both graduate and undergraduate is $138,500 in Stafford loans. If you're in medical school, that amount increases to $224,000 for subsidized, unsubsidized Stafford loans. And again, those are loans for undergraduate and graduate students combined. You have payments usually start 6 months after the student leaves school. They're going to qualify for the student interest loan deduction, and they're also going to qualify for consolidation under the federal student loan program. So those are the major things for the unsubsidized Stafford loan. They do have repayment options when you go into repayment. They are going to qualify for income-based repayment or pay-as-you-earn, and we'll talk about that in a few minutes. I need to take a drink of water. Bear with me a second. Okay, federal subsidized Stafford loan. This loan was available to graduate students up until June 30th of 2012. I believe that's right. Yes, June 30th of 2012. It used to be $8,500 a year unsubsidized. Okay, that loan was discontinued, and after June 30th, 2012, the Stafford loan, which was unsubsidized at that time, was $12,000. It was increased to $20,500, as we just talked about. So Stafford loans that are subsidized for graduate students are no longer available. Let's move right into the Perkins loan. Again, 5% interest fixed. The loans, usually the funds come from the school. There are no fees in Perkins loans, whether they're undergraduate or graduate. It's just a straight disbursement of the funds. The dollar amount in which can be lent each year to a graduate student increases to up to $8,000 a year for the graduate student. And the maximum amount that they can borrow in Perkins loans for undergraduate and graduate work in total cannot exceed $60,000. Okay, let's move right on to the Perkins loan. I'm sorry, to the Grad Plus loan. Now, this came out in July 1st of 2006. Under the legislation that approved this, a Grad Plus loan was set up in which the graduate student could apply for this loan. They could borrow up to the total cost of college, less any financial aid or other loans, and they would not have to start to pay this loan back until after they left school. It's much like the Parent Plus loan, but with a few exceptions. As we talked about, there were multiple ways to repay a Parent Plus loan. This one, payments are just deferred until after the student gets out of school. Then they have different repayment programs they can consider. As I said, they can borrow up the total cost of college, less other loans, aid, or any educational tax benefits. Payment starts 6 months after they leave school. Interest on this the interest rate on this loan is 7.21%, just as the Parent Plus loan is 7.21%. They also have a high fee. That fee this year is 4.292, and that fee is deducted from the loan proceeds when it's dispersed. There is a cap on this loan for loans dispersed after June 30th of 2013. The interest rate cannot exceed 10.5%. And again, why it happened after June 30th of 2013, that's when the new legislation went into effect, where rates are determined on an annual basis, again tied to that 10-year Treasury note. They have repayment options of income-based repayment, pay-as-you-earn, standard payment, graduated payment, so they have a lot more options here. This is going to qualify for consolidation under the Federal Student Loan Program, and it is going to qualify for the student interest loan deduction if the student's income falls beneath the phase-out limits. Okay, private education loans. These were the sole source, really, that many students used for graduate work before June 30th of 2006. They would get a private education loan in order to fund their graduate work. Since the Grad Plus loan came out, many students moved towards that loan versus the private education loan. Even though the rates may be lower under the private education loan, the consolidation options are not as good as they are for federal student loans. So again, they're probably going to want a co-signer for this private loan. There's no cap on the rate. There could possibly be fees. It's going to be a credit-based loan. Payments are going to start after college, and they usually just have a standard repayment program, nothing that could help as far as income sensitivity that the student might have. And they are very hard to consolidate. Okay. Let's talk a little bit about consolidations here. You have two types of consolidations. If you have private student loans and you have federal student loans, you cannot consolidate them together under the federal student loan program. You can only consolidate federal student loans under the federal student loan consolidation program. Students can consolidate theirs, parents can consolidate theirs separately, each one. You cannot combine these to consolidate them. So again, it has to be the same borrower. Under this program, there's a cap. The interest rate cannot exceed 8.25%. They take the weighted average of all the loans, the interest rates of all the loans, to determine the new interest rate. And I have an example in the notes I sent to you on just a quick case study that shows how the weighted interest is determined. I won't go into the details on that. You can take a look at the notes and see it there. I think it's going to be a lot more self-explanatory once you see it. It does have the death and disability benefit that is going to go with you on a federal loan, whether it's a Stafford, Perkins, or Plus loan. That is going to go with you into the consolidation. There's no income or credit check. So again, all you have to do is fill out the application, process it through, and you can do the consolidation. The Department of Education is doing the consolidation. Now, they do not service the loan. They have several companies they contract with in order to do the servicing of the loan. So Sallie Mae, Great Lakes, Nelnet. You'll see these lenders coming up all the time when you do a consolidation, or even when you do a student loan, a federal one. They are just servicing it. They are not taking over the loan. U.S. Department of Education is still the lender on these. Also, they have some help in that they could possibly extend the term. And what I mean by that is all these federal student loans are on a 10-year term or 10-year payback. Student comes out of school where the parent has a student come out of school, they want to consolidate their PLUS loans, and they've got a 10-year term, they might be able to extend that term up to 30 years depending on the dollar amount being consolidated. The same thing with the student and his or her federal student loans. Consolidate them. They're on a 10-year term before that. Afterwards, they could be on a term of up to 25, 30 years depending on the dollar amount being consolidated. And again, the death and disability benefit follows you into that consolidation. Now, there's been a lot of talk as far as federal PLUS loans and taking them out and everything. I think you have to really look at the individual situations of the family. The interest rate is extremely high. Okay, there may be other options as to borrow for college, but I think you have to look at, the interest rate's high, but what's my financial position right now, and what is it going to be when the student gets out of school? That parent has to start to look at what their obligations are going to be. Are they going to be going into retirement? Are they in their late 50s or 60s already? In those situations, a federal PLUS loan may look attractive. Private loans. This is where you can consolidate private student loans that have been taken out in the student's name. Now, there's 3 lenders that are involved in doing this. Right now it's Wells Fargo, Citizens Bank, and Credit Union Student Loans. They are consolidating private student loans and spreading them out over a term that's could be anywhere from 10 to 30 years depending on the individual lender. What is really interesting here and what we're starting to follow is Citizens Bank here back in September started a new program to consolidate loans. And what they were doing is they were offering to consolidate federal student loans and to offer with that the death and disability benefit, and also to spread it out over a term longer than 10 years. Talking to them myself, they're trying to mirror the federal student loan consolidation program. The one thing they don't have right now is they don't have variable repayment options. It's usually just a standard repayment option. So again, that's unusual. What's even a little more unusual is Citizens says, okay, if you have federal student loans and you have private student loans, we'll consolidate both of them together, and so you'll just have one loan program. So again, it's an option out there. We're going to have to see how this evolves as we go through here, but it is available. I want to give the answer to question number 3 for CPAs and CCAs. The answer to question number 3 is standard. Again, the answer to question number 3 is standard. Okay, we're moving along here. I want to get down to some stuff here. I want to do a quick case study here on income-based repayment, and this is just to give you a general idea how this works. In this situation, the graduate is a law student. They've got 3 years of law school. They've got federal student loans totaling almost $77,000. They have monthly payments available to them. On a 10-year term, it would be $2,062. 20-year term would be $1,383. 30-year term would be $1,190. They have an adjusted gross income this year of $90,000, and the federal poverty line for 2014 is $11,670. Now, take that information. On the next slide, we're going to see how we apply that. Well, first of all, we start out with the adjusted gross income of $90,000. From that, we subtract 150% of the federal poverty line, or that $17,505. That gives us what's called discretionary income when we're going to figure out what the income-based repayment is going to be. That discretionary income in this example is $72,495. We divide it by 12 months to get a monthly discretionary income of $6,014. Now under our IBR, that payment is 15% of your monthly discretionary income, or in this example, $906. So in summary, here are the 3 loan repayment terms they have without IBR, and this is under the standard repayment. So if you have a 30-year term, the lowest you're going to pay under the standard repayment is $1,190. If you qualify for income-based repayment, that monthly payment is going to be $906. So there's going to be a savings there of almost $300. The borrower, though, must apply and qualify for IBR each year in order to be able to participate in the program. So you may have a situation where a student may come out, may qualify for income-based repayment for 1 or 2 years. After that, they may not qualify. Okay, let's take the same example, but now let's apply the new program called Pay As You Earn, or PAYE. Again, all the terms, all the assumptions in the case study are the same. Let's go right to the next one. What's different here is when you come down to the monthly discretionary income, it's still the same at $6,014. But under Pay As You Earn, or PAYE, it's 10% of discretionary income and not 15%. So before under IBR it was $906. Under PAYE it's $604. Now we're talking about some substantial savings on a monthly basis. Standard payment would be just under $1,200. Under PAYE it would be just over $600. For students that are working and having problems that they can't repay their loans, students that are having problems repaying their loans, even if they're not working, applying for income-based repayment or PAYE may ease their problems. If they have no income, I've seen situations where there has been 0 monthly payment for 12 months. So again, something to consider. And again, the borrower must apply and qualify for IBR, or that's a mistake there. That should be PAYE each year, not IBR. I thought I had proofed this pretty well, but obviously I haven't. Forgive me. Okay, in summary, if working full-time in a public service job, any remaining debt after 10 years of timely payments will be discharged tax-free. Okay, so if you qualify for income-based repayment or PAYE only for a couple years, but during the full 10-year period you work in public service job, that's for state, local, federal government, or a nonprofit, you make 10 years of timely payments, you can request a discharge of any debt that remains after that time. And it is a tax-free discharge. Now, one of the things you have to remember is when you have to make the application after the 10 years have timely payments have been made, or the 120 timely payments, you have to be employed in the nonprofit or the public sector when you get approved, and you have to be employed in the public service or nonprofit when you receive the forgiveness. So just going 120 payments, you make the application and you leave that job the next day, you're not going to get a forgiveness of the debt. So just a note there. If working full-time in non-public service, a regular job for a for-profit entity, any remaining debt after 25 years under income-based repayment or 20 years under Pay As You Earn, if timely payments, they can be discharged, and the amount of debt discharged will be subject to income tax. Okay, so this sounds like a great deal. It's a long time, but people are saying, well, I still have a chance maybe to get some of this debt forgiven. Don't get so excited. Okay, if you think about somebody who had $100,000 worth of debt after 25 or 20 years and qualify for this forgiveness, and the debt is forgiven, what you then have is a situation where you have $100,000 of additional taxable income, and you might be subject to a 25% tax rate or $25,000 tax on that forgiveness. So if you're having problems making payments in the first place, you may even have a bigger tax problem later on. Okay, we're getting close to the end of the hour here, and I want to get some questions in here. Public Service Loan Forgiveness Program. not going to go into a little detail. I just want you to be aware of this. We're going to be doing more on this in the future, 2015 here. The Public Service Loan Forgiveness was established to encourage individuals to enter and continue in full-time public employment by forgiving a remaining balance of their debt, direct loan debt, after a number of qualified timely payments. Who's eligible? You must be employed full-time by a public service organization when you are making your qualified payments at the time of applying for loan forgiveness and at the time that you receive the loan forgiveness. And again, how does this program work? You must be employed in a public service organization. You must make 120 qualified on-time monthly payments while working in that public service organization. Payments must be for a direct loan, okay? Now, let me just take a quick second there, go off the path a little bit. There used to be two federal student loan programs, the Federal Family Student Loan Program, or FFEL, and the William D. Ford Direct Loan Program. The FFEL loan program has been dissolved. It's no longer available. All loans are done under the direct loan program. If you have loans that are under the FFEL program, they're not going to qualify for income-based repayment or for public service loan forgiveness. What you can do, though, is request a consolidation of those loans under the direct loan program, and therefore you would then qualify for the program. Payments must be made after October 1st, 2007, so as you can see, we have not experienced anyone asking for forgiveness of debt yet, because it's a 10-year program at least, so not until November of 2017 would we see anyone coming out requesting for forgiveness of debt. And payments must be made under a qualified repayment plan, which is one of the plans that are available when you do a repayment under the federal consolidation or federal repayment program. Okay, those are the items I wanted to cover. I wanted to get back and see if we can get maybe to some questions here, so bear with me a second. I've got to open up the questions. Okay, we have a few questions. Let me just get to them here. First question is, what is happening with a community college not counting as a second student in college? That's something that came up recently. Some schools are saying that if you have two children in school and one is going to a community college, that some schools are saying that that child going to the community college is not going to be considered as a second in school. This has just come up recently. I have not seen anything new about that. We're going to be at the Department of Education's conference down in Atlanta. This is obviously going to be one of the things we're going to be talking about. When do our colleges stop bragging that their average student graduates have less than $27,000 in debt? I'd like to know that too. I mean, if we look out there and we look at student debt, right now it's at $1.2 trillion, and that's just debt in the names of the students. That does not take into consideration federal plus loans that are in the name of the parent. I think if we started to put those in there, we'd look at a total student debt, both for student and parent, probably exceeding $3 trillion. Point of clarification here, both parents denied get extra $4,000, both parents as in parents listed in the FAFSA. Good question. In order to get the additional unsubsidized Stafford loan because you've been turned down for a plus loan, it has to be the two biological parents. Okay? Now if you have a situation where there is a divorce and the mother has remarried, she's the only one that can apply for the plus loan. Her new spouse cannot. Now the question comes down to, can the father, the biological father, who is divorced now, can he apply for a plus loan? Yes, he can. He does not have to file a FAFSA because under a special rule of the Department of Education, if the biological mother or the biological father that's taking care of the child has filed the FAFSA form, the other spouse that's been divorced does not have to file it in order to get a PLUS loan. That being said, though, that other parent has to be turned down also in order to get a PLUS loan. And this can be a real tricky situation because you may sometimes not even, the other parent may not even want to apply for the PLUS loan, or they can't even find the other parent to do the application. And in that situation, you go back and you do a petition to the college. Question we have here, have student loan interest rates for 2015-2016 been set yet? No, they haven't. They're going to be set, the federal ones are going to be set here in late May of 2015, and then we'll be coming out with the new rates for Stafford and for PLUS loans. Okay, Perkins Max plus Stafford Max. Okay, let me go back and just go to that real quick. The maximum Stafford loan for an undergraduate student cannot exceed $31,000. The maximum Stafford loan, the maximum Perkins loan for an undergraduate student cannot exceed $27,500. So you have two maxes there. $31,000 for Stafford, $27,500 for Perkins. Okay. What is the minimum credit score to get approved for a Parent Plus loan? What I've seen, or I've heard anyway, is somewhere in the area of 640 to 650. Again, I would, we have a member, David Ratliff, that does a lot in the area of credit. I will go back and ask David to see if those are still good numbers, and I'll send an email out to everyone. I need to take a note on that. Okay. The question is here. Can you explain consolidation? How does it work to a single Stafford loan? Okay. If you have a single Stafford loan and that is a payback on a 10-year term, you can consolidate one loan by itself, and you would they would look at the loan, the dollar amount, and depending on how big that loan was, with interest accrued onto it or whatever, whether it would be for a 10-year term or longer. It could be like for 12 or 15-year term because the dollar amount's so low. But you could consolidate one Stafford loan by itself under the Federal Consolidation Program, and you would do that online at StudentLoans.gov. Okay. Let me give it the final answer to question number 4 here, so if those that need to go can go. The answer to question number 4 for CPAs and CCAs is forgiveness. The answer to question number 4 is forgiveness. I understand if you have to go, that's fine. This is going to be up on the website if you want to listen to the rest of the questions later on, that's fine. Are Federal Plus loans ever packaged by colleges as a component part of the student's financial aid package? Answer to that, sadly, is yes. In fact, Paula Bishop did an excellent presentation here. I think it was in late spring on award letters and what some colleges are doing. And you will see Federal Plus loans for parents as part of the aid package. Very misleading for them to do this. Some families think they've got all of a sudden have a full ride until you explain to them you've got a plus loan that's got to be paid back over X number of years. So it does happen. Question is here for Parent Plus loans, does parent get the student's interest rate deduction? The answer to that is yes. If their income falls beneath the phase-out limits, parents with plus loans can deduct student interest on their tax return. Question is, what is the range of interest rates available under private student loans today? I've seen advertisements in the 5.5%, 6% rate. I think what you're really going to see is these rates are going to be closer to 7%. If you think about it, private loans, only competition is a federal plus loan, and that's 7.21%. There's no real incentive for these private lenders to go much below the 7% range when their competition is high too. You might see some very good credits where it might be down in the 6.5% rate, but I wouldn't expect to see it much lower than that. I hope I'm wrong, but that's what I think it's going to pull out as. Let's see. If the family has private student loans with a co-signer, and if the parent is repaying, can the parent take the student interest loan deduction? In that situation, no. The only person that can take the deduction is the one who is the borrower of the debt. So you have a private student loan in the student's name. Mom and dad are making the monthly payments on that. They cannot take the student interest loan deduction. The only person that could take it would be the student, and the way to do that would be to gift the money to the student and then have the student make the payment directly to the institution. Any other way, you're not going to get the deduction. Okay. Is the Grad Plus loan a loan of the student or of the parent? A Grad Plus loan is a loan of the student, and I'm sorry, I should have clarified that a little more. It's for a graduate student. It's in the student's name. It's not in the parent's name. Okay. I've got a long one here. Let me go on to the next one here. Question here, is there easy access to software that could illustrate the increase in debt if they choose to extend the payback term? I think the best way is you can go on to the internet. Even Excel has a program on debt amortization, and what you do is just do a schedule. Put in the terms and conditions. Put in $20,000, let's say for 10 years at 4.66%. What's the payback going to be? Then take the same thing and put it in for 25 years and see what the payback's going to be. So you can either get this off an Excel program, or you can even go right to the internet and they'll have amortization schedules. Okay. Okay, question is here. Are the rates on federal consolidation loans a mathematical average of each of the loans and rates they are consolidated, or can these loans effectively lower the aggregate interest a student pays for his or her current outstanding loans? What they are is their weighted average. Okay, so is it going to make a substantial impact on the total debt? No, not really. They're just doing a weighted average. They're trying to get it into one payment. There may be a slight advantage interest rate wise in doing a consolidation, but again, they're using a weighted average. Okay. Let's see here. Question, very good one. Should term insurance be placed on a co-signer in case he or she passes over to the other side? This is a co-signer now, okay? I think that co-signer would want to have an insurance policy, a term policy on the original lender, I'm sorry, the original borrower, the student itself, in case that student should pass away. And it might even be a good idea for the co-signer to have a policy on themselves, because the estate is going to assume the position of the co-signer if the co-signer dies. and the lender may go after the estate for some payment if the original borrower is not paying. Again, it's a legal question, but we're talking money here, and we're talking lenders, and they're going to look for whoever they can to pay, whether they are successful or not. Will payee amortize the loan? Okay, good question. Income-based repayment and payee may not amortize the loan. And this is an important thing. I'm glad it was brought up here. If you do payee or income-based repayment, and you have subsidized loans in there, and your payment doesn't even cover the interest on the loans, for the first 3 years, the government will pay the interest shortfall on those subsidized loans. They won't pay the shortfall on the unsubsidized, but they will on the subsidized. After that, they will not pay any shortfall on anything. And you could very possibly have a situation where you have what I call a negative amortization of the loan. In other words, the payment that's being made is not even covering the interest on the loan, and the loan continues to grow. Let's see, can you consolidate just the years with high interest rates and not the ones with lower rates? Answer to that is yes. You can select individual loans that you want to consolidate. So if you had some loans that were at very low rates, example, let's say you had someone who had been going to school for a long time, had loans that were dispersed before June 30th of 2006, their interest rate is 2.33%. That may not be a loan that you want to consolidate. You may want to keep that out of the consolidation and just consolidate the other ones. So again, you'd want to do the mathematical computation to see what the impact of that very low interest rate would be on the total package, and then see what it would be without it. If they have income-based repayment or pay-as-you-earn but can pay more, can they do that and pay the loan off earlier? The answer to that question is yes. Okay. Now, be very careful here. Do not just send in a payment to the lender. Okay. What they're going to do is they're going to prepay payments into the future. They're not going to apply it to the principal just because you send in an extra payment. What you do in that situation, you have an extra payment, or I'm sorry, if you have a lump sum payment you're going to do, you put it in the form of a letter that you want the enclosed payment to apply to principal only and not to future payments. And you send it certified mail, return receipt to make sure that they get it. Okay, what happens to interest accrued on IBR as you earn, and the pay-as-you-earn scenario? Is the interest compounded based on the full principal? Yes. I think we just talked about that. If the interest is not paid, that's going to be added onto the loan, and the loan will continue to grow. Does working for a state university or a nonprofit organization qualify as a public service? Yes, I would. I would assume so. I would go back to the institutions and verify that they qualify under IBR and pay-as-you-earn for the Public Service Forgiveness Program. But they're nonprofits, I would assume they would. Let's see. Where does a student apply for IBR or pay-as-you-earn? When they do their application for consolidation or for repayment of their loans, there is a form you can fill out under StudentLoans.gov for income-based repayment or pay-as-you-earn, and you can apply for it right there. Again, I usually print out a paper form if I can, and I mail it in certified mail, return receipt. Okay, payment calculation for IBR and pay-as-you-earn are rounded up to a straight percentage. Did you say what that amount is? And what that is let's say the average weighted interest rate comes up to 6.7%. What they do under the rules is you round it up to the nearest eighth of a percent. So under that program, it would be rounded up to 6.75%. Good question. Thank you for bringing that up. I did not mention that. Let's see here. Perkins loan. Are Perkins loans part of the FFEL program? No. their loans that are lent under the federal government direct loan program, I'm sorry, not the direct loan program, under the federal Perkins program, and this funds are from the Department of Education and from the colleges. Can grandparents get a PLUS loan for their grandkids? I'm sorry, you can't do that. It's only for parents of the student. Our, let's see, how hard is it to qualify for income-based repayment or pay-as-you-earn? Really what they're going to do is they're going to look at a copy of the prior year's tax return to see if you're below that poverty level or fixed into the computation I showed there on the slides. If it's late in the year like now, what they might ask for is a copy of your last pay stub when making the determination. But if you go back to that formula I presented, that case study on income-based repayment and pay-as-you-earn, just drop some numbers in there. You can get a general feel whether you're going to qualify or not. 6.4%, okay, let's see. Stepfather can apply for a PLUS loan if his information was required. The question here is, can a stepfather apply for a PLUS loan if his information was required on the FAFSA for his stepchild? Answer to that question is no. Only the parental parents, parental mother or the parental father, can apply for the PLUS loan. Okay. Let's see, we just have a couple more here I want to get to, and I'll let everyone go. Will loan forgiveness under the Public Service Loan Forgiveness Program be tax-free? Yes. And what I mean by that is if you're working for a nonprofit and you're under the Public Service Program, that's a 10-year forgiveness after 10 years, and that's a tax-free transaction. If that forgiveness of debt occurs because of a for-profit organization after 20 or 25 years, there's not going to be any, it's not going to be a tax-free transaction. Okay. Let's see here. One last question. If you have a chance, please send me. Okay, okay, that's not a question. Okay. I do have one that came back here saying that the step-parent is allowed to apply for the PLUS loan. I will confirm that with the Department of Education, and I will get an email out to everyone that if I'm incorrect, we'll make a correction on that right away. So, okay, that's what we have for today. I do appreciate your time. I know we've gone a little bit over, but I wanted to get to as many of the questions that I could. And again, look for 2 emails from me, one on credit rating for PLUS loans and the other one on a step-parent being allowed to apply for a PLUS loan. So again, everyone, thank you very much for your time. Have a great Thanksgiving, a great holiday. And we're going to have our next webinar on September 17th on the FAFSA form. I do have one thing I would like to publicize before I leave. We're trying to get together a webinar on the GI Bill. We've had a lot of inquiries on this. If anyone has any contacts that we could possibly get a hold of regarding the GI Bill, please send me an email or give me a call, because I think this is a very important area and a lot of us need to know what's going on in that area. Again, thank you for your time. Have a great weekend and a great holiday. Bye-bye now.